Good afternoon and welcome to our webinar, 3 Things to Consider Before You Sell and How to Create an Effective Succession Plan, which will be presented by IT Economics, Ryan Beaulieu, and Keith Butcher of ButcherJoseph. My name is Lindsay and I will be moderating our webinar today. Before we jump in, I have a couple of housekeeping items to go over. Your microphone will automatically be muted throughout today's webinar. We will have some time for questions at the end. To ask a question, simply enter it into the chat box and we'll address them in the last few minutes. Any questions that are not answered during today's webinar will be responded to via an additional TrendStock episode with our podcast. If you have any technical issues throughout today's webinar, please feel free to contact Anne through our website chat or by emailing customercare@itreconomics.com. A recording of this presentation and the slides will be emailed to you in the next 48 hours. Thank you all. Thank you all for being here today. And I will now turn it over to Brian.
Thank you, Lindsay, and thank you all for joining us. I'm excited to be doing this webinar with our good friend Keith Butcher. I'm really looking forward to what he has to say. As a matter of fact, having seen the slides, you're in for a treat. My job is to sort of tee up the economics, and Keith is going to show how it applies to your world and how to create an effective succession plan, 3 things to consider before you sell. So let's get on with the economics part of this. As always, we like to show a track record. This is from March of 2020 when we were in the midst of COVID. Remember, the stock market was careening downward. The governors were shutting down non-essential businesses. We had data through either late 19 or early 2020, and we virtually went through all of our forecasts and had to scrub most of them, all of them, because COVID changed everything. These 8 headline items that you see in the first column on the left, they haven't changed. They're the same ones they always have been. The duration is shorter. Usually you'll see 12 to 18 months there. Now it's only 9 because it was from March to the end of last year. And you see how we did our forecast track record. We think we had it right because we saw COVID as a natural disaster. And we treated it as such. We studied prior natural disasters and simply blew them up on scale to drive our expectations. The government came through very quickly, very fast with all sorts of relief, but they dealt with it like they do everything. They see everything, in this case anyways, as an economic disaster. And they've since created all sorts of liquidity issues, 2 different price bubbles, and a supply chain fiasco, all of which we'll briefly touch upon. This is our outlook for GDP out through 2024. The dark blue is what has actually occurred. The green bars are our forecast points, and you can see that we're calling for the rate of rise to slow down there in 2022 and into early 2023 before we pick back up and we start experiencing accelerated rise. Please note, there's no downturn, there's no overt weakness. We have a favorable runway ahead of us. The last 4 quarters have been up, and as far as we can see, the next 36 are going to be up also, and on into 2025. This is just as far out as this forecast goes. So experiencing positive problems, increasing demand, all of that is going to be contended with, tight labor, etc. In terms of the supply chain issues, notice that all of these ports are bringing in more than they were pre-COVID. The supply chain is functioning as best it can amidst a COVID slowdown, energy issues now in Europe and Asia, and hyped up demand here in the United States. And if I showed you container traffic worldwide, you'd see that that's accelerated greatly. We have simply strained our supply chain. We have not broken it, and that's the good news. Our supply chain issues will abate. Over the course of 2022 and 23, we expect them to abate for a couple of reasons. One, supply issues are being ameliorated in the way of chips. New foundries are being built as we speak. Demand is going to be slowing down. So we have supply chain being built up. We expect COVID is going to become less of an issue in major ports in China. That is an expectation. That's not a proof. And you slow down the rate of rise in demand, and you're giving the supply chain a chance to get caught up. And that means you'll see prices normalize, and you'll see profitability more realistically gauged and more realistically planned upon. Doesn't mean it's all gravy out there by any means, but it's going to be a more rational supply and demand world as we go through 22 and 23. For the US economy, it is growth ahead. The green line here is US total industrial production's 12-month moving average. And you can see that it is rising. And what you saw vis-a-vis GDP is that that green line is going to continue to rise out past 23 and all the way through 2024. We're into another one of those nice elongated rising trends. The blue line is the value of mergers and acquisitions just here in the United States. And you can see that's positively correlated with the overall economy, whether you use industrial production or GDP. So that green line going up means valuations should stay high. There's a nuance here. We're fairly early on into this rising trend, and look how high that blue line has shot up already. It's about 2-3 years ahead of schedule in terms of the sheer height that it's gone to. So how much higher can it go? That's where our friend Keith comes into play. All we can tell you is that the economic environment will remain favorable. The liquidity is certainly out there, but we can also tell you this is ahead of schedule compared to what normally happens coming off of a cyclical low. And of course, I want to touch upon this concept of leading and lagging. GDP and industrial production, those are coincident indicators. They're right in the middle. And you sort of spread out from there to develop leading indicators and lagging indicators. In this case, you're looking at one of the leading indicators, housing. It's not the foremost leading indicator, but it's widely recognized. And you can see its green line has turned around, which means that while housing is going to continue to rise, the year-over-year percent increase is going to diminish, but there's no recession. And then the blue line is non-residential construction, and that solid blue line on this rate of change scale is just beginning to curve up. So remember, on a rate of change, we're taking the latest data and we're comparing it to 1 year ago. So housing is flying high, very high above year-ago levels, running around 20% ahead of year-ago levels. And non-residential construction, which lags housing by 25 months, is just now moving toward being equal to where it was 1 year ago. 25 months is a nice long lead time, and that green has actually occurred. We have shifted the green 25 months into the future. So you can see how well it prognosticates highs and lows. It's incumbent upon you, if you're going to be selling a business, to know whether you tend to be on the leading side or the lagging side of this curve. It is going to affect your net proceeds at the end of the deal. Don't assume that you move with GDP. We gave you that overall landscape, but if you're in the non-res construction field, your timing is going to be different than if you're a home builder or if you're tied to GDP. Inflation is clearly an issue, and the more inflation you have, the more eventually it will compress multiples, and that's just logical. Inflation is not bad right now. We don't expect it to get out of hand anytime in the next couple of years, which is a little bit of a controversial statement. So let me show you some reasons why we think that. One is this picture. You're looking at very low US bond yields. This is the 10-year government bond yield. This is a monthly endpoint. So it ended last month at 1.4%. Yesterday, we were at about 1.59%. It's been up to 1.65. So it has come up since the end of last month, but we're only trading at pre-COVID levels. That's all we've gone back to. But the bond market is telling us, and we look at the bond market all the time, is that it is not seeing problematic inflation out there in the future. Lesson number one. And have an uncanny ability. The bond market can see about 18 months into the future very well. And this very low yield is also saying that the bond market, remember, it's bigger, smarter than the stock market, is telling us, look, we don't have a problem with how much debt the US government is taking on at this time. Now, a lot of us individually have a lot of questions, and I have very good reasons to have questions. That's a different program. All I'm showing you is that the smart money right now is saying the inflation threat isn't imminent, neither is our deficit crashing down around us or bringing the economy down imminent. It just makes this a good time to take advantage of the money. This is just one of the slides that I think you should know about. That vertical axis that I've drawn there is actually April 2009. And that is when, whoops, I thought it was going to, April 2009 was going to pop up on there. That's when that brown line shifted above a key mark. It's in economics, and there's all sorts of studies that support this. I'm just demonstrating it to you with this simple slide. Once you have more than 80% GDP to nominal, 80% of your debt to GDP ratio, in other words, your debt is equal 80% of your GDP. Once you go above that, you've reached an inflection point, a tipping point, if you will. And you can see how to the right of that vertical axis, industrial production really hasn't been growing like it once did. And that's just conveying to you what most economists know. Now, if you talk to a money market theorist, the money market tree folks, modern monetary theory, they'll tell you deficit spending doesn't matter. Well, it does matter. And the more deficit spending there is in the future, the more it inhibits our economy's ability to grow. Why am I telling you this? Well, I guess a couple of reasons. One, at ITR Economics, we don't see this trend line miraculously going the other way. You're looking at federal debt here. It's not going to go the other way, and it's, as a percent of GDP, it's going to remain onerous. And the higher that trend line goes, the more difficulties we encounter in terms of ability to grow, the more likely we are to encounter higher and higher rates of inflation and more trade issues. So that's the second point. If you're thinking about selling your business, you want to do it while people are still comfortable, right, with the future, rather than increasingly wringing their hands because of higher and higher inflation and more trouble growing. And the third point I want you to get off this chart is that it really started, the brown line deficit spending adding to our national debt really started in the 1980s. And I didn't bring along all the charts and tables, rather breaking it down versus Republicans and Democrats, who added how much, when, and how much, what party is responsible. Suffice it to say, you've had Republicans and Democrats through this entire period. And I just want to break any delusions you may have that one party is necessarily better than the other when it comes to managing the rate of rise in this debt. They are amazingly similar in how they approach government and how they approach getting reelected and how this trend line goes up. So don't believe in political miracles. We are on our own here, folks, in terms of our businesses and deciding what's best for our families.
Hey, Brian, quick question.
Yeah.
So when you look at this slide and you look at the slide before and you look at the cost of money, I think what most people think is, or what confuses and scares people, is they look at the basis of debt now, like how the platform of how much it's raised and the cost of what it costs us today. And they envision, well, what if we had to pay 4 or 5 or 6% for that money? And now we've got this level of debt, and their brains like blow up into how would we ever pay for that sort of thing?
Well, if you're talking about how a government would pay for it, they would pay for it by cutting back on other discretionary spending if they had that sort of fiscal backbone, and or they would scale back on the entitlement programs if they had that sort of backbone, or they would raise taxes on anything that moved. particularly wealthy people. They would be raising those taxes and transferring that money into the entitlement programs. Therefore, the timing of when we get into that sort of range is crucial. By the way, you mentioned 5%. 5% happens to be the median rate of interest on the 10-year bond yield. So we've been living a dream for very many years now. Take it one step beyond that, Keith, because I do. Corporations, their leverage as a percent of GDP running around 30% is at an all-time high. And that made sense. We started seeing that percentage creep up as those interest rates were going down. Okay. And as that red line goes down, interest rates in general go down, you'd expect to take on more and more debt because it's cheap money. But when there's inflation out there in the future and interest rates are going to go up, then that leverage gets to be very burdensome. So it's not just the government that needs to worry about all that leverage. Corporations do also. And a delevered corporation out there in the future is going to be much more highly valued than one that has to carry that leverage at an increasing rate of interest.
Exactly.
All right, let's see if I can get this back. The thing about inflation that I want you to notice is we have the CPI rate of inflation, rate of change, that blue line, peaking at just under 6%. And historically, we would expect the Federal Reserve to start boosting interest rates at about now, if not before now, because of that. But they don't calculate that issue like they used to. Before Chairman Powell, it would be enough for them to be raising the Fed funds rate or certainly changing the discount rate. But they do a look back period now. They're looking at average inflation historically. And they know it's going up to about 6%, but they also think, as we do, that it's going to come back down toward 2.5%. And therefore, they don't need to worry about it. You and I need to start worrying about inflation after it reaches that next low. You can see ITR is projecting it'll be about 2.5% out there in 2023. Then we start getting into compound inflation. How this compound interest, well, this compound inflation. We're not seeing a big reset like we have before. In fact, at 2%, you're looking at a relatively high trough, all driven by current monetary policy, which takes time, my friends, to become real inflation, labor shortages, which are going to continue ad infinitum this decade unless we get some sort of coherent, documented labor program, immigration in this country. We're going to see more and more commodity price escalators, which simply systematizes inflation. And that deficit spending that I was just showing you is a very real contributor to inflation. In terms of the issue of job openings and labor shortage, look at these job openings. I mean, this is incredible. These are 12-month moving averages, right? So that's smoothed out, but we're still looking at incredibly high numbers at a time when labor participation remains weak. And it's fascinating to me anyways, because I'm an econ junkie, that it isn't just in the United States. We're seeing this same phenomena of job openings, declining labor participation in China, France, and other economies. Where we're not seeing it is, I guess, not surprisingly, in Germany. Labor participation rate remains very high in Germany. It remains very high in Japan. So it really does change from one economy to the other. But here in the United States, we've got a systemic problem. And we are going to have to figure out how to become better and better at retaining people and paying them more money. And we're going to have to figure out how to pass through that in terms of cost burden through to our customers. We were talking about inflation and interest rates just a moment ago. This is our outlook for U.S. government 10-year bond yield. And we have it staying low through 2022. I'm pretty sure that's what the bond market is forecasting, but then it's rising in 2023 and in 24. And then it switches into annual forecast points beyond that. We don't really get ourselves into deep trouble in terms of financing, paying for this debt until we get into the late 2020s. And we assume we can forestall getting out that far because we are still the world's favorite world reserve currency. Now, if we lose that, and there are any number of ways we could lose that, if we lose that, then this escalation in interest rates is going to come much sooner and much harsher. We could lose it because we don't move fast enough with digitizing the US dollar the way the Chinese have digitized their currency. We could lose it because people just lose confidence in the full faith and credit of the US government. And we're beginning to see that fray around the edges already when you look at our world reserve requirements. It's not a given that they will always have confidence in us. So this forecast you see here says, even assuming that they remain confident in us, by 2029, 28, the wheels are starting to come off the cart, which means you and I want to be good for gone long before that happens in our businesses. One few more minutes, and then I turn it over to Keith. I want to talk about the financial markets, stocks in particular. You're looking at stock market here, the S&P 500 raw data, and the green line is domestic profitability. And if you look at the scale, you'll notice we're not going up in equal increments because we're on a logarithmic scale. We're comparing the percent change of these two data series through time. And you notice right now that the blue line is running above the green line. The green line of late got a nice little boost, by the way. That's a COVID boost. A lot of PPP money turned into profits. And that was a uniquely American phenomenon, by the way. Most governments weren't just giving away money like we did here in the United States. So we saw a little bit of closure, but you still have this amazing gap between stocks and the blue and profitability, which cannot last forever. We all learned along the way that stocks represent ultimately the present value or future profitability. And there's no way that the profit's going to go up to rationalize that blue line. We're in an elongated dot-com situation, in other words. And it's not unsurprising that it was the technology stocks that were leading the way through this period. Eventually that green line comes down, the blue line, stock market comes down to get in line with the green lines, profitability. That happens in concert with a recession, all right? So even if we have a price correction in the near term, it's just a correction, it's not a bear market. Bear markets happen in concert with GDP decline. And I just showed you that we don't expect a GDP decline through 2024. We really don't expect one until maybe the fourth quarter of 2025 or later in 2026. So we have time before this bear market hits approximately, but we don't have forever, okay? And that's just something to keep in mind when we go to this next slide, because I'm showing you stock market again. The S&P 500, this time it's a 3-month moving average, so the value of mergers and acquisitions. And when that brown line, the stock market, goes down, valuations obviously have a tough time. They go down also. We haven't been keeping pace with the overall rise in the stock market. I think that's probably going to be closed. That gap is going to be closed over the next year, 2 years. But one thing I do know is that we're not going to hold on to these valuations when that market goes into its ultimate, eventual, has to be bear market. And again, no one can time that for sure, but it should occur in association with that mid-decade business cycle recession. So we've got a runway ahead of us. That's what I'm trying to get across to you in terms of GDP, in terms of the stock market not going into a negative trend. But it's not rich forever. We've got years, not many years, to figure this out. So before turning it over to Keith, just to summarize, if I may, inflation is here. It eventually will be compressing multiples. The economic growth is here also for the next 3-4 years. Stock market is living on the edge. And when it turns into that bear market, it is going to all of a sudden decrease our opportunities. And don't plan on some sort of change in the body politic to save our bacon. We're past the point of no return in that regard. And history doesn't suggest that Republicans or Democrats are better than one over the other in terms of bringing home what we need for real growth long-term in our economy. So with that having been said, Keith, I'm going to turn it over to you, sir, and tell us what do we do with all this, please?
Perfect. Thanks, Brian. All right, let's push forward here.
Hey, Brian, here we go.
There you go. So when you take the backdrop of all of that great economic information and then you try to take it down to the M&A market, and particularly what we're focused on is folks who are selling their business for today's discussion. And so thinking about what is the impact of all of that on them. And a lot of it is this same theme. It's a simple theme, which is no buyer wants to pay the best price or the highest price if they don't feel like they have a really good runway in front of them. Like they don't want to have the hot potato at the very, very top of the market, and then they got to like beat the market to succeed ahead. They want to buy companies when those companies have a run rate and the economy is going to support that. And so what we'll kind of walk through here is how do you take that data and you process it into sort of real deal terms and executing on transactions today. And so the first thing we'll talk about is value. And when I say value, I joke around all the time with all of our clients. They say, how much is my business worth? And I said, well, it really depends on what kind of transaction you want to do. And what are the values that you value in it? And that comes to the second, which is impact. Because most founder, and I'm talking about founder owners of business specifically, they have a lot of wants and needs in a transaction that are beyond price. Like they say, well, I don't want the headquarters moved out of our little town in rural America, or I don't want my employees to lose their job, or I really want my leadership team to stay in place. And you go through all of these other stakeholders, and every time you start adding more complexity to the deal, the upfront price goes down because the buyer goes, well, I can do all that stuff, but you're tying my hands on the flexibility I have in the deal. And that comes to process and structure, which is how do I get my proceeds, and what are going to be the strings around that, and how are they going to tie me up so that either I'm involved going forward, my money's involved going forward, or in some way, shape, or form, I'm not sort of completely getting liquidity. So let's move forward. So determinants of value. So if you go back to Brian's comments the whole way along, I think the number one thing right now in executing deals is this economic environment. And it's coming out of what was a completely dynamic, never imagined underwriting for a pandemic. And so we come off of that, and we have businesses that some are winners, some are losers, some are sort of, middle of the road, kind of were non-COVID affected. But at the end of the day, what every buyer of a business right now is looking at, and they're saying, well, what's the future going to hold? And I think that what most folks are saying is exactly what Brian walked us through, which is you got some runway right now. There are indicators that the government's going to support that going forward, because we still have a lot of brain damage over the pandemic, and we want to continue feeding into the economy, some of it not organically, right, from the government. And so when we look at what's going to be the value of a business, the first thing is going to be, of course, how is your company performing? But a whole lot more about price today is about all these market forces, and about the economy, and about the tax environment, and going forward, how are all these things going to triangulate? And so we'll walk through some of that as we go through here. So, and I would point at the top part of this slide is just sort of, we had years and years ago, one of our clients said something pretty smart to us that we hadn't really thought about. And they're like, well, geez, everybody talks about these companies that are valued at 9, 10, 11, 12, 15, 20x, times EBITDA, or earning kind of the unlevered free cash flow of a business. And then they also talk about companies that don't get to enjoy those types of multiples when they sell. And they were like, what's the difference between those two things? And so we got together and kind of thought through it, and we made a whole list. And this is just a very short version of it. And all of it was so obvious. But on the other hand, when you made a list of it, it was such a useful thing. And now as we have new clients come in the door, I hand them a list, and I say, here, they say, how much is my company worth? And I said, well, you tell me which of these characteristics are your business? And then I can help you guide you there. And it really is the stuff that, if you think about it, it's everything about the buyer. Like I always tell folks when they're selling a business, put yourself in the buyer's shoes and act like you're buying your business. And what would be the stuff that would keep you up at night? And what are the things that you've known you always kind of should have fixed, but you never got around to it? And it's all those sorts of things that you have to be honest with yourself. And what that does is, it's not that you can't get a great bit, like the environment today is, and I tell everybody this, we could take about every business out and get you a really nice offer. That does not mean that deal will close, because everybody will put a piece of paper in hand and say they will pay you an outrageous price for this business, but getting that to execute and close is kind of a different thing. And that's the tough part. That's the art of the deal today. And we'll talk through that a little bit. But so the current market factors that we are constantly thinking about right now that are affecting it is COVID performance is everything. And when I say that, I don't mean bad performance and I don't mean good performance. I just mean being able to explain to a buyer the effect of this COVID pandemic on your business is such a critically important thing. And understanding the effect on your business is really critical. I think the volume of M&A, you saw Brian's chart where he's showing, so just the sheer volume of M&A right now is staggering. And I wish I was smart enough to understand why it is as aggressive and as passionate as it is right now. But I do know that the reason, a big driver of high valuations is really the dry powder that's out there in the marketplace and the cheap capital. And the fact that, frankly, banks are sitting on massive deposits. They're awash with cash. They've come back into this market in such a big way, and they are the lowest cost of capital to get into an M&A deal. And so you can afford to pay another turn of EBITDA or 2 turns of EBITDA. You would have paid 7 times for business. Now you can pay 9 because your average cost of borrowing's 2.5%. Right? If we went back in time, Brian and I lived in a time where you couldn't borrow for less than 7 or 8%. And I didn't see a lot of 10x businesses back then. This is, I'm not going to go through a lot of this just because a lot of it Brian already went through. The one I would note is the one in the lower left corner, which is really that dry powder. I mean, this is private equity is the private equity funds, so professional financial buyers of businesses. They are the most constant and largest market for deals around the world. And if you look at the amount of capital that they have committed to their funds that has not been put to work, it's staggering. And they're charging fees on these commitments, and their investors are expecting those dollars to flow in and buy assets that are producing a return. And so that has created a tremendous pressure on all those fund managers to get out there and start buying stuff. And that's a lot of what's driving the market. Let's go to the next one. So as we look at the traditional buyers of the business, I threw a fun one in at the end, but like everybody talks about, oh, the strategic buyer, there's a magic room that all investment bankers know about, whereas where that's where the buyer is for your business, who's going to pay the highest price, has the most synergies, the whole thing. And the reality is, when we have clients come in and we talk about a strategic buyer, we look and say, listen, it's a really small list of folks who truly you fit like a puzzle piece into what they're trying to do. And yes, if we find the person that you fit in the puzzle piece, they absolutely will pay the highest price because they have the most to gain. It just makes sense. Now, they may not take care of those other sort of stakeholder issues that you wanted to take care of, but that absolutely is the highest price. But it's not the widest audience, and it's not the most likely, at least in the middle market, it's not the most likely transaction buyer of your business. The most likely is private equity funds that we talked about in terms of those. They pay great prices. I would say they even pay sort of strategic prices in today's market. And their deals are pretty clean. We don't see tons of earnouts right now just because the market is so aggressive and it's such a seller's market that sellers wouldn't expect it. I think as you see Brian's forecast come to fruition, and we're 3 or 4 years down the line and interest rates have gone up and GDP has slowed down, and you're going to see private equity come back, and we're going to see much more structured deals. where they're exchanging risk with you as part of the purchase price as a seller. And then the final piece that we've seen grow, and our firm does a lot of this, is this concept of trying to sell your company to your employees through an ESOP or management buyout. And it's interesting, over the last 10 years, I won't go a long way on it, there's, and I don't know if it's an institutional guilt of founders, but they have much more valued a end result that values and legacy and pushes, the other stakeholders. And if you asked an owner, hey, if I could get you close to the same value and close to the same liquidity as these other buyers, would you rather just sell it to your employees in your leadership group? And 99 out of 100 times, they would say, yeah. Now, does that exist in the market in reality? No, there's not a lot of liquidity in that market. So that's why it's not a big market. But it is interesting how much more it's in the news. And I joke around, like 10, 15 years ago, I used to have I have one of these Google word search things comes up every day just for ESOP. And I used to get like one article a week. That's how much activity was going on. Now we get 10, 12, 15 a day. And so it's obviously risen in interest. Let's go.
Before we go on, Keith, what about ESOT, employee, instead of stock, purchase, the company, that trust purchases it and doles it out to the employees. Are you seeing that happen too?
Yeah, and that's actually that's the employee trust piece that I'm talking about.
Okay.
That's exactly and it's interesting. We're seeing it because, and it's a weird thing to say, but I really do think it's kind of true that we have some founders who are guilty. They made a whole lot of money, piles of money, built up their business and did that. And they look at an exit and go, okay, well, I'm going to get another whole pile of money. And the employees and the leadership group are sort of left with the next person, the private equity firm or the strategic buyer. And what we're seeing in the market is there are more funds, there are more credit funds, there are more people that will support those style of transactions by a multiple than there were 10 years ago for sure. But it's still really small. Like if there was, like if you think about the overall whole market, if there's $1 billion of capital available for those transactions, that'd be about it in today's market. And there might have been 100 million of it 10 years ago.
Okay.
And that's,
thank you.
In the scheme of the whole market, it's tiny, right?
Fascinating. Thank you. Let's see. Here we go.
There's a lot going on this slide, so I'll try not to terrify anybody with it. But what this is, we sit clients down and we say, listen, what is the value you're trying to get out of this transaction? And many of our clients are founder owners who are that traditional story, husband and wife, they got around the card table in their living room and they pulled out a blueprint. And they said, hey, we're going to start a business and here's what we're going to do. And we're going to put our life savings at risk. And then we're going to start it and build it. And 30 years later, it's a big business now. And they went through a lifetime of anxiety and risk and personal guarantees and all the things, and went out and had to collect receivables in the Great Recession and all the life experience of entrepreneurs. And at the end of the day, we have to take all of that and tell them nobody's going to pay you for that life experience. What they're going to do is they're going to pay you for the value of the business that you have. But what you can be paid and where you can get value is sort of thinking about all the things you want out of it. And some owners are like, listen, I really would just like my money and I want to be done and I want to go to Palm Springs and do a lot of golf and live my life. Great. We see more and more folks who want sort of the ultimate solution, which is, listen, I'd love to take care of my employees. I'd love to all the things. I'd like to take care of all the stakeholders in the business. And so when we put this, we're like, but there's an exchange there. There always is an exchange. It's rarely the top value and the top price when you try to bargain all of those other things into a deal. And that's sort of the confluence of all of these items on here. And it may mean that you help the buyer with the purchase price, that you give them a better value or a better price because they're willing to take on some of these impact and legacy items that are important to you. And that's all the trade. And for us, we tell clients all the time, listen, we want to get you the highest price. That's our job. But at the end of the day, you determine what other values you want and how that affects price. Let's move on. This is a terrible slide, but But it does make a point. And the point is, in most transactions, the things that the stakeholders that sellers are trying to take care of, and even buyers are trying to take care of, are all of these items. So no buyer wants to buy a company whose employees and management group don't want to stay. That's sort of like a given, right? And so how do you take care of that? Well, you take care of it through some of these techniques, which is, from an employee perspective, it's picking the right next steward of the business and being able with a straight face to go out to your employees and say, hey, listen, we sold the business. It's gonna go to this group. And by the way, they're a wonderful group. We recently sold one of our portfolio companies for our private equity firm to a public company in Europe. And they are a fantastic steward of their business in Europe. And they did a wonderful job of coming here and convincing us that they're going to take great care of this company and these employees. And their rollout to the employees once we had made the decision was really impressive. It made us feel bad, and they made us look like that we were bad owners before because they were so good at it. But that's the thing, is you want to get somebody who can speak that language to your employees, talk to them on that level so that folks are comfortable. From a management perspective, it's all in today's world, a lot of it's about management incentives. Those folks, they look at it as I'm a professional manager of a business. I'm going to have an owner. That owner expects me to make them money. And how do I participate that in that in a meaningful way? And the work you do ahead of time as a seller in setting up some of these management incentives, even if they're purely based on some kind of change in control in the future, where you say, listen, management group, we're going to build this business up. And eventually I do want to retire and I want to sell this business. And we're going to set up today some type of equity plan for you, so that when that occurs, it's going to be an event for you. And a lot of times that event for them, part of that is going to roll into the next deal. And you just made it more valuable, the business more valuable, because that buyer loves the fact that there's a pool of management capital that can go into the next deal. Makes them feel great that those folks are invested. It adds value. I mean, it actually affects price. And so, and then I guess one more thing, at the bottom are all the other tertiary considerations that everybody that's selling a business enjoys. So legacy, local community, suppliers, customers, credit partners, all these people. I mean, we hear a lot about suppliers that they're like, geez, I've been working with so-and-so for the last 25 years. I don't want this new buyer not to use them anymore because we're a really important customer for them. And it's sort of an interesting thing that sometimes I feel like we're psychologists as well as advisors as we go through these. So I said at the very start, and I mean this, that the most important thing going on in a transaction today, the art of the deal, is actually getting it to close and getting the money to transfer at the price that you agreed with at the start. Because the nature of this market is that you go out, you get a bunch of wonderful bids, and unfortunately, people are underwriting the transaction to perfection. Like, they are underwriting and they're putting a price in front of you when they bid that every single thing's going to be perfect when they get into diligence, and that all of it will be good news. And so the ability to hold the line and get a very high price at the start and then hold that price throughout a diligence process. And so normal deal structure, somebody is going to buy your business. They say, I'll pay you whatever, $50 million for it. It's a wonderful price. Business owner's really happy. We sign the deal. They have 60, 75 days to do diligence, where they're coming in and they're poking around and trying to find out all the information they can before they write the check. From the day you sign that piece of paper and you start diligence, do you realize what the buyer's trying to do is talk themselves out of it the whole time? That's literally their process. And so what we counsel our clients is, from the time you sign that, you need to go into romance mode, where every day is good news for that buyer. Every day you're telling them the next exciting thing that's happening in the business, because at the same time they're trying to talk themselves out of it, you're selling them into it every day. And that is the process today, because folks are uncomfortable with the prices that they're coming out with at the start. These are not middle of the range deals right now. It is a incredible sell side market right now. And the second piece is that you have to put a process in place that is incredibly disciplined and fast. And what I mean by that is, time is your enemy. Bad news is your enemy. Like, the dynamics of the world are crazy right now. You never know when there's going to be another surge. And then You've got a buyer who's like, oh, geez, what's this leg? What's going to happen with this leg? And they start getting in their own head about the business. And then they come back and they try to retrade us. And it's all that kind of stuff. And so it's really important to keep stuff on a very tight timeline. We build, generally, if we go exclusive, we build really set timelines and really set goals that they have to achieve along the way to maintain their exclusivity. And it's really critical. We call it kind of the last mile discipline. And the final piece is, and this is back to Brian and the economics and truth behind a process. 50% of the time, buyers are coming back and saying, hey, I got kind of uncomfortable about a few things, and geez, we would like to tighten up our valuation, and we might have to bring the value down and retrade us. And one of the most critical things you can do and be prepared for is to have actual facts about the world to be able to translate in that moment, and not let it just be a generic sort of, oh, I'm uncomfortable as a buyer. And that's when you say, hey, listen, what's making you uncomfortable? Oh, I don't know where we are in the cycle. Oh, okay, well, here's a bunch of macroeconomic factors about the world we live in and how folks are forecasting it forward. Which of these things do you think is not truth? Because you're an expert economist now. Because it looks like to us, you got 3 or 4 or 5 years of good run ahead of you. That's the value of that type of data and information, because market forces are affecting valuations more than anything right now. So key takeaways, I think that the low cost of capital, and you saw Brian's slide, so you see sort of in the future, how long a run do we have? So the first thing is, as a business owner, don't wait until the last minute. Don't think that you're gonna enjoy the climb of your business to the very tippy top and then unload the hot potato on somebody else, because you will get repriced before that, because the market is efficient and people are not dumb, and they know when there's not enough run rate ahead of them, and the market will reprice before that. And so if you want the best price for your business, you got to think in terms of, do I have a 3, 4, 5 year run rate that with a straight face, I can tell a buyer you're in good hands with this market. And you don't have to beat the market, which is what buyers hate. The second is, once you decide, time's your enemy. Put it on a tight timeline and make it your number one priority. And the third is, if you ultimately, for the greatest satisfaction of what happens to your business, take the time ahead of time to plan for it. And we joke around all the time with folks that act like you're selling the business every year. Think about that in your sort of strategy of your business. And you don't have to sell it, but boy, it's a healthy process to think about how buyers look at your business, identify the weaknesses of your business, and shore that stuff up ahead of time, and take that energy, particularly if you got a little time. I think we went through our prepared comments there, Brian.
Well done. You made it very clear and very manageable. Great job, Keith. So, Lindsay, do we have any questions waiting for us?
We have one question in the chat box, or another one just came in, but I will read the first one. Are sellers not providing complete information prior to getting a price, such that there are few surprises in due diligence?
It's a good question. So what the question, I think, paraphrasing that question, what you're saying is, do we not get enough information up front before we let somebody into diligence that we've identified all the things that are going to be a problem in diligence? And we generally, the question is really good. We generally do understand ahead of time with our client what the hot spots are that they're going to hit along diligence. So we're prepared for those things. But I think what you're seeing today is I guess what I'm saying is you're seeing weak excuses that really aren't based on real diligence data about why they're uncomfortable with their price. And that's what you have to be prepared for. And it's very, very frustrating, because a retrade, it's a passionate, angry thing, right? But I think that's what we're saying is I wish it was just, okay, we knew these 3 things would be a problem in diligence. We have a we have some customer concentration, a customer, and that customer, we're renegotiating a contract in the middle of the deal, and we know that's going to have some headwind around it. Sure, we can identify that and think about it. The stuff that we're hearing is more, I feel like there's not enough run rate. I feel like something, and that's when it's a challenge.
It's interesting, Keith, to me that you play in a very high stakes world where there's really no earnest money ever involved until the very end. It's
yeah, it's different. There's different structures, but the traditional sort of middle market M&A world rarely has sort of hard dollars, like unlike a real estate deal, right? Where you would have a hard dollars or cutoff where you'll give me the purchase agreement and you're going hard money on this date and you got that to lose. The M&A world, it used to be like that. And it's all gravitated to this game of chess between these two characters. And their only real detriment is their out-of-pocket expenses that they've incurred, right? To walk away from each other and reputation and all that stuff. But it's it's an interesting trade, but you're entirely correct. The whole time like I say, we're selling from the day we sign to the day we close.
Which only increases the value of the person who can actually bring it home, knows the art of the deal and can actually execute. And that's the key. Yeah,
I mean, and that's, and I think about, we actually have a service we do for people who have an offer that comes in. There's tons of people that are getting offers that are unsolicited, right? Somebody comes in the market, they've identified you, and they put a really great offer in place. We develop just a line of business that's just designed to help that seller navigate that process, not go out and market the deal or do anything, just from that offer to a closing. And the whole reason is because sellers didn't used to need this when it's a middle of the range kind of valuation. But the problem is that these are really great valuations, and to sustain that, you really do need that help to get there. That is the art of the deal right now, but it's also fun.
Or else you wouldn't be doing it.
Exactly. I think I saw some other questions come up.
Yes, and I believe this is a follow-up. So is it an intentional bait and switch? Is that more specific to private equity or strategic buyers?
Well, I don't know if I'd use that language, but I think it's what I just described is exactly a bait and switch. So it's hard for me to take my words back, but I don't know that it's intentional. If folks are intentionally trying to do that, I think there are folks out there that do it. But at the end of the day, I do think private equity is a bigger. They do it more often than strategics, and the reason they do it more often than strategics is because they learn more in diligence. Like a strategic already understands the business, and so when they come into diligence, they can be awful in diligence because they do understand the business more. But private equity firms tend to get into diligence, and they're on this learning path that they didn't really know a lot about the industry, or they didn't really know a lot about the business, and then through diligence, they're teaching themselves, and they scare themselves in the middle of it.
Perhaps it's because there is so much liquidity in that space that they can afford to have a shinier lure cast out there to try and attract some attention to.
Well, and also, Brian, I think they have to go outside of their industry focuses to get money to work. And so they might have 3 industries that they're really good in, but a nice shiny business comes up in a 4th industry they're not so familiar with. And they're like, well, it kind of feels like the other industries that we've done, so we'll jump on that one because it's available. But they don't have that institutional knowledge, so they're learning on your dime during diligence, and they scare themselves in some aspect of it.
Great. Next question we have. The window is closing to avoid whatever tax changes are in the works. What are the tax changes coming up?
Well, specific to M&A, I think there's a couple of things coming up. One is, well, I would say there's 2 that are very directly affecting a shareholder. One is in the Ways and Means. Like I tell everybody, the only thing we know is we know what the president wanted, we know what the Ways and Means Committee said, and we know what the current law is. And in the Ways and Means Committee, what they basically laid out is a 5% increase in long-term capital gain and a 3% sort of excess earnings tax over $5 million. And so if you've got a sizable transaction, you're basically looking at, in total, a 31.8% long-term capital gain plus your state. And that includes also the investment income tax. And so That's as opposed to today of 23.8 generally, unless you're, directly involved in an S corp. But that's the difference today. And what we tell clients right now is, as far as the Ways and Means Committee, their proposal is to take it back to September 13th. And so if you're closing your deal after that, you should be closing it with the assumption that you've got to pay the higher tax and not be disappointed if that ends up happening. None of us know if any of it will get passed, right? And I was telling Brian yesterday, we were talking, and I was telling him, we have 2 transactions right now where our buyer was going to step away, or seller was going to step away because of he just doesn't have a good feel for what tax he's going to pay, and it makes a difference to him. And so he's like, well, I guess I'm not going to go forward. And we've had 2 buyers step forward and essentially basically say, listen, we will step up the value for the difference in tax if it changes between now and the end of the year, which never in my career would I have expected that to happen. But that's how much these folks don't want to lose a deal.
It's interesting under that, not that particular instance, but deciding to go forward with the sale or not based on a future tax consideration. If you say not because you don't want to pay that 31 and change, then you're making the implicit assumption that it's going to be lower at some other point in the future that's advantageous to you. Yet, as we've talked about, without a clear run rate, with higher interest rates out there in the future, you really have to do some good pencil pushing to find out which way you're going to come out ahead, which way you're going to roll that dice. It's not a given by any means that the rate would be coming down, or that in the future interest rates going up and other inflationary pressures aren't going to work against your valuation. So it's an interesting play right now to say no deal because taxes may be going up.
Well, think about it like this, Brian. So if Congress gets this passed and they raise the taxes, so go back and look at the crucible they had to run through to get to the control position they're in today to be able to get 50-50 in the Senate, right? And watch how we were all watching Georgia to see what happens at a runoff, right? That's the crucible that had to happen. So what's the chances that another party's going to come in and run that same crucible and get all those things to line up so that they control all 3 and can get it through? And that's, to your point, is that could be 20 years from now.
Yeah.
And to your point, I think there's going to be a reset of, it's going to be hard information for a founder owner to take into their heads and figure out that taxes just went up by 8%. And now if I'm in California, I'm paying 45%, just picking on California. And for a minute, they're going to have to take a breath and they're going to absorb that information, and the M&A market will slow down while they're thinking through that. But then I think the rational stuff you're talking about is going to come up, and they're going to say, well, I'm still in the same position I was always in. I still have to do something with this business. I could hold on to it, pay a higher value or pay a higher tax and get a lower value because there's less run rate ahead of me, and I get hit by both.
Yeah.
But that's going to be hard medicine for folks to, absorb first, right? It's going to take a minute.
Yeah, you're right. It's a mental pause and a reshaping of the timeline and everything else. But those are the new realities. There's no way about it.
For sure.
All right. We have 2 minutes left. I'm not sure if you guys want to answer one more question, or we can save them for our podcast and we can kind of wrap it up here.
Well, might as well use our 2 minutes for a question.
Alrighty. So this question, supply chain issues look to be 12 to 24 month duration or more. Shrinking labor force is most likely longer term or permanent. How much do you factor these into your analysis of the future run rate of the business being considered?
Well, I'd be interested in Brian's view on 12 to 24 months.
We think it gets better, but it'll be between 12 and 24 months before we're looking at normalized supply chains. I can't speak to perceptions of run rate, but I can tell you that we have it factored into all of our forecasts, whether the macroeconomic forecast or the company-specific forecasting that we do. And it's one of the reasons what the normalization of the supply chain and figuring out the automation that needs to be done and obviating labor, et cetera. just look at the CapEx spending that's going on, and the type of CapEx spending that's going on is part of why we see a reacceleration of the economy and many businesses in the second half of 23, 24. So through the time frame that we've been talking about, we don't see those as being restrictive issues. They become more problematic on the other side of 26.
Yeah, and I would say in terms of the second part of that question, where they're saying, you know, well, how does that affect the run rate, or how does it affect that business going forward? And I would say the businesses will figure out efficiently how to address that. They're not going to just accept less margin or accept less profit. They will figure out how to do more with less. They always do. And they will figure out how to spread that pain across the entire supply chain, ultimately under the consumer. And they always do. And they'll figure it out, and it'll cause innovation, and it'll be to the detriment of labor, honestly, ultimately.
To those that can't figure it out, they're going to be bought up on the cheap at the next cycle, is how that's going to work.
They're going to be in that 4X category.
Yeah, you're right. We only have one more question, Keith. You want to take it so that?
Yeah, why not?
Okay.
Let's see. Please talk about the benefits and downsides related to earnouts versus all cash offers.
That's your bailiwick, Keith.
Yeah, I mean, the detriment is you have taken on the risk of the future, and you are providing an insurance contract for your buyer. And so it's not that it is a terrible thing to do in a deal. I would say in today's market, it would be unusual to have an earnout, just because the market's pretty competitive and your leverage is against somebody else buying it, right, who would pay all cash. But if it's a stretch of a valuation to get to win the deal, and if all of your other options are all cash and this one's all cash that equates to everything else plus an earnout to win the deal, that's not a bad trade. But earnouts, inevitably, we joke around. Earnouts, it's like everything else. The only person who wins in an earnout is the lawyers, who fight over it later. And structuring an earnout is it's critically important, because everybody always forgets what they agreed to at the time they did the deal, and a buyer hates to write another check later. And so I feel like I always tell clients, I said, we can have an earnout, but just get ready to fight for it. Like, they're not going. I've not met many buyers who are like, hey, you guys did great, here's your earnout money. They usually have they're like, oh, did we have that in that contract? I forgot about that. Did you hit those numbers? And then there's a whole thing.
Yeah, it needs to be exceptionally well written, and you certainly don't want to do it near the end of the run period, or else you will be in litigation. There's no.
Well, I mean, to your point, Brian, if you are at the end of that, if you're going to go into a cycle where you don't feel as confident, then you have to beat the odds to get your earnout, right?
That's that risk you were saying you have to assume as the seller. It is a risk. Keith, this has been a lot of fun. I hope we get to do it again sometime in the future. And I've really enjoyed everything that you brought to the table today.
Perfect. Well, thank you. And you guys have a great weekend.
Okay. Thank you, Lindsay.